Welcome to The Riff, where writer and investor Byrne Hobart and I discuss the major inflection points caused by technological change. Our weekly conversation covers the obvious and not so obvious ways in which markets and businesses will adapt as a result. Let's jump right in. Hey, Byrne, can you hear me okay?
I can hear you, and there's zero lag.
Excellent. Let's start with the Silicon Valley Canon. Tanner Greer wrote a great post about sort of this conversation, or inspired by this conversation that happened on Twitter, where Patrick Collison shared the books that he recommended. Mark Andreessen also shared the books that he thought make up the Silicon Valley Canon. What did you find so interesting about it, or what do you make of the idea?
Like it's nice that there is a canon. It's nice that there is a list of books where part of, I think what makes some kinds of institutions more exclusive is that you don't actually know what the rules are. And so you're not in, and you have no idea how to get in, and you just don't really know what the criteria are. And so it's nice that there is this list of books where if you read them, it doesn't mean that you are immediately a Python wizard or something. But what it does mean is that you have some common ground, you have some understandings, and you sort of have some of the same concepts in your head that founders of companies you respect and investors you respect also have in their heads. So I think tech does have this weirdly open ecosystem where there are just a lot of publications about things that are of interest to practitioners in the industry and to potential practitioners. I've written in the past about the phenomenon of engineering blogs and how they just don't seem to exist as much in other spaces. Like you don't really, I mean, maybe they do exist and I don't find them, but I don't know that there's a robust ecosystem of surgeon blogs where they're all trading tips and where they're giving each other advice. And obviously it's much higher stakes if you're, doing the equivalent of your nights and weekends GitHub hobby with a scalpel or something. But there is, I think, more of a tradition of openness in tech. And it seems like that actually extends to helping people be aware of what the cultural undercurrents are. And also, I think it's a reminder that the critique that tech people don't believe in the humanities is, it's directionally true in the sense that they do spend some large fraction of their time doing non-humanities things, but it's also kind of a weak criticism. It's certainly much, much easier to make that criticism in the opposite direction and say that people in the humanities often have really weird opinions about tech and do not seem to express very much interest in doing tech. There are a handful of counterexamples. There's certainly people who come from more of a background in philosophy or history or the arts or whatever and end up picking up coding and end up becoming tech people. But it is just, it's way more common in my experience to talk to a friend who's a software engineer and hear about a history book they read or a philosophy book they read or a novel they're reading than it is to talk to someone who's in the arts and, hear about the esoteric programming language that they are picking up in their spare time. So yeah, so that post, it was a good post on just the Silicon Valley attitude towards books. That piece also goes in some interesting directions, talking about the difference between tech people and policy people. And one of the claims it makes is that in the policy space, you actually have people who are much, much more deeply specialized than anyone in tech is. And this again is like a criticism of tech of someone learned a couple programming languages and they got a really nice job and now they're an expert on geopolitics and economics and whatever. But it could also be the case that if you have this category of jobs where there is a cutoff, like there are very high returns to being smart and working hard and knowing a lot, and there's a set of people who've opted into those jobs, those jobs do select for those traits. Like you should expect that a random tech person's opinion on unrelated issues is going to be better informed than the average person's. And there is there are some intellectual spaces that just don't select very hard in favor of rigorous thinking, where like if you ask people in some discussions, if you ask them, okay, like what are some real world consequences that like we would see if your beliefs were true? It's like the first time that question has been raised about something they view as just a fundamental, really important fact about the world. And it seems like that kind of epistemic habit can lead to a bubble where it is really obvious to these people that the tech people are crazy and misguided and totally irresponsible. And there's not really a strong effort to engage with them. And then when tech people try to engage with their ideas, it does seem like, they're sniping, they're critiquing, but sometimes there's just not a lot of substance to the complaints about these companies and about tech culture in general. it does feel kind of petty at times. Like there are still valid complaints, but I feel like I feel like there's a lot more rigor in listening to what a small tech company says about a big tech company's misbehavior than there is in hearing what non-tech people say the big tech companies are truly up to.
And so when people typically talk about, like, they like to straw man sort of the Silicon Valley perspective as sort of this like libertarian, techno utopian, sort of like politically naive, we just look at everything from first principles perspective.
All directionally true, by the way. Like every one of those stereotypes is an accurate stereotype. It's a stereotype for a reason.
Yes, yes, yes. Stereotypes often contain at least directional truths. And so do you see sort of the Silicon Valley perspective evolving? Tyler Cowen once said that he thinks Peter Thiel is the most important public intellectual alive today. Do you think there's any merit to that? Or how do you think about Silicon Valley's sort of intellectual evolution or growing intellectual influence?
Yeah, so I think it is true that tech has some pretty strong biases and does have particular framings that tech people like. Like I think a lot of tech people are very libertarian with respect to whatever it is that they're doing, and then a whole lot less libertarian with respect to certainly what the platforms they're dependent on are doing. Like and that's just a natural state of things. You want to be able to build the thing that you believe is a thing worth building. You really don't want to be crushed by some company that's just trying to increase margins this quarter for whatever reason. And of course that company has a lot of leverage over you. So you do feel like the underdog. And I think that is actually a part of a driver of just the general tech attitude, is that the companies look really successful, and their success, like that up and to the right chart, is a chart of lots and lots of near-death experiences avoided. And if you go back and read about companies' early histories, you can find a lot of cases where the company was very, very close to failing. And you also find a lot of instances of CEOs acting paranoid about how their company is on the brink of failure well after it looks like their success is completely assured. Like people talk about Microsoft, like early 90s Microsoft, being just terrified that that a lot of applications would move online faster than Microsoft got religion on the internet, and that even though Microsoft had been using email for a long time, they weren't really they hadn't thought of the world as being a browser centric world where the operating system was just less important, and they had to catch up really fast. And you see that with Meta too, and in fact you can even see that quite recently, like within the last couple of years, that they decided that short videos are actually an important medium and that people will use those to express themselves. People will also spend a lot of idle time watching them, that they will be monetized, and Meta gave up billions of dollars of regular newsfeed revenue in order to make sure that they had a strong position in Reels. And the quality of the initial version of Reels, like the actual content, it was not good. And it seemed like all of the good content on Reels ended with a TikTok logo. But eventually they dumped enough opportunity cost and put enough eyeballs on it that did work out. So I think that tech people do feel more like underdogs, and one of the reasons for that is that they are actually more like underdogs than is widely recognized, just in the sense that companies do come and go. There are companies that were once quite important and in fairly short order became pretty insignificant. That is less true of the biggest, most dominant companies right now, but that may be a more temporary period. Yeah, I feel like you had I think I took that in a different direction than the initial question you asked. So I'd like you to re-ask the question you actually wanted me to answer, and I'll get to that too.
Is Peter Thiel, Tyler Cowen called Peter Thiel the most important public intellectual? Is there something to that? Is he leading Silicon Valley intellectual influence, and how do we think about the evolution of that, or if that's increasing or growing?
Yeah, I think there is you can make a strong case, and some of that is a case of negation. That it's just I don't know who I would put on the list of most important public intellectuals, and I feel like if you put someone on that list, you are inviting an argument about how they're not really important. But what you're not really inviting is an argument about how somebody else is actually a more important public intellectual right now. So we do sort of have maybe a shortage of that, or maybe it just looks like that in retrospect. And maybe if we were looking 50 years ago, the figures we could name today as having been really important to the world at that time were just, they were seen as some of the people you would see on TV. They're publishing books and that people are reading them, but they're not necessarily canonized yet as the most important public intellectuals. I do think that 0 to 1 in particular did have a very strong influence, both in terms of how it talks about companies and growth, but also how it framed it as a broader question than just here is a way to make money, and here's how it's different from the other ways that you would make money. Because I think that to some extent you can look at the decision to move into tech. If you think of it from the perspective of someone who is choosing a college major, one important factor is how much money are they going to make, and will their parents think this is a cool job? Will their girlfriend's parents think this is a cool job and not tell her to date someone better, basically? Will your friends think this is a cool job? Like those are all salient concerns. And so to some extent, there is this question of, should I major in computer science and try to get a job at Meta, or should I major in finance and economics and try to get the job at Goldman? But I think there was also this framing of tech and startups as being part of this deep pattern of human behavior that like some of the later chapters and some of the lecture notes go into this idea of the founder as the God king who is ritually sacrificed in order to avert mass violence. And when you're building your SaaS app, you tend not to think of yourself as a God king, but it does put it in perspective and tell you that there are these broader patterns of how people live their lives, what they actually aim to accomplish in their lives, and also how they relate to one another, and that those patterns can be recreated in different contexts and with different labels, but you'll have fundamentally the same pattern. You can, if you go back and look at, say, the taxonomy of governments, as it can be democratic or oligarchic or monarchical. Like, you can describe a lot of institutions as either it's run by everybody, or it's run by a small collection of unaccountable elites, or it's run by exactly one person, and that person is pretty synonymous with the company. There's that tendency to sometimes treat the founder and the company as kind of the same entity, that you say Zuck did X when you mean Meta launched launched a product that did X, and you kind of treat them as the same. And it's like the old linguistic tick where it used to be semi-common in literary terms to refer to a monarch by the name of the country, that you would use the term England to refer to the King of England. So they're like that pattern of, we're taking a large institution where most of the work is being done by somebody other than the person in charge, and most of the outcome is determined by the efforts of somebody else, but we are treating it as synonymous with one person. And that's just an easier thing to think about than to try to model this large institution in your head. So I think that is an important point, and I think it is, the danger there is that you are telling people that the work they're doing is of more cosmic significance than they realized. And if you find someone who is making a lot of money and they are very, very visibly successful, and you tell them, no, you're actually even cooler than you realized, that is obviously dangerous. But dangerous to them. They can end up kind of on tilt. But it also may be true, or at least it's useful to ask yourself, like, Napoleon was an actual human being. He had a childhood, he went to school, he got a job, and then he very quickly got a sequence of promotions. We don't really have modern Napoleons. We don't really expect there to be any new Napoleons, but it's not like there was some Napoleonic spirit that was just, it was around in the late 18th century in Corsica and it will never be back again. Like, there are clearly people who are on that spectrum, or they're on the Lenin spectrum, or they're on the Deng Xiaoping spectrum, or whatever, and they're doing other things. They don't necessarily have the job opportunities that allow them to seize control of a country, or they don't see getting elected as a very interesting thing to do, but they still want to acquire power, have a large impact on the world, see their will, enforce their will on others. And tech is actually at least like tech and the capitalist system in general is a pretty pro-social way to do that. Like, I think massacres pay a lot better in politics than they do in business and finance, and a lot of other just sociopathic behavior is kind of constrained by the legal system. So it is probably a really good thing that whoever the modern Lenin is, that modern Lenin is probably doing really, really well as a salesperson somewhere, or as a co-founder of some company, and not seizing control of a major country and really messing it up.
Speaking of, think of what you're working on as cosmic significance. You wrote about mission-driven companies and how they have higher variance at times. So why don't you unpack that argument?
Yeah, I mean, some of it is pretty straightforward that if your company is trying to maximize profits, there's a pretty narrow range of things it's going to do. And if your company is trying to make humanity an interplanetary species or make information, make the world's knowledge accessible to everyone or make intelligence too cheap to meter, it'll make different decisions. And I think you can look at two kinds of evolution. Like the vast majority of companies, they are a job. It is a way to make money, and they are a way for someone with capital to see that capital grow. But the company is not trying to accomplish something that only that company can accomplish, that will not be done if that company is not built. So if you have a steel company, you just don't need that company to exist for there to be steel. Someone will make it. They might make it a little bit better, they might make it a little bit worse, but there will be a substitute. And there isn't really a substitute for something like SpaceX. For Google, like there is at this point there is a substitute, or there are companies that could credibly build something like Google. It probably would take a long time to get as good as Google is, but it could happen. But bringing Google into existence was this kind of mission driven thing. It really only made sense. The business ended up making sense in light of the mission. And so it does create pretty unique companies, but it does add a lot of variance, because if you're trading off between mission and business interests, one way that mission driven companies, they don't die, but the mission dies, is they just gradually tilt things more towards how do we make money and less towards how do we accomplish this really important goal. PayPal is actually a fun example of that, turning back to Teal and 0 to 1, where PayPal, their early goal was a lot closer to the goal that a lot of crypto people have, of make it so that anyone can transact with anyone, that currency is not controlled by governments, that people have freedom to denominate their wealth in whatever medium they choose to. Apparently the book Cryptonomicon was really, really popular in early PayPal. And eventually it just became clear that, one, that's not going to happen anytime soon, and two, this whole thing of making it slightly easier to buy and sell Beanie Babies on eBay, like that is an actual business and can make enough money that the whole project was worth doing after all. So you do have companies that kind of drift away from their mission, and maybe someone comes back and decides that they're going to do the mission-driven version of that company again and do it better. And then there are other companies where they have a mission and they sacrifice financially in order to achieve that mission, and they end up just running out of money and they fail. So that's where a lot of the variance comes in. And one way to look at it is that the business side of this institution ends up being the shock absorber, where if there is they're running a business in part as a way to fund whatever the end goal is, and in part as just a metric of, are they on the right path? Because if you have some really high level goal for making the world a better place, you can just tell yourself that you're working towards that goal and that's what counts. But it's probably a good idea to come up with some metric by which you are actually improving the world. And one of the really convenient ones that markets offer us is, if you provide a good or service and you are able to compete with other people providing similar things, or you're the only person providing that and people will pay you money for it, then that is a pretty good sign that you're doing something of value, because people have exchanged something they value, i.e. their dollars, for your good or service. So it can be a good way to both fund some long-term goal and ensure that and measure the extent to which you're actually achieving it. But you do still have to consider that there are trade-offs. And if you run into some kind of material constraint, like let's say there's a recession and you have to choose which cost to cut and which cost to keep, the more mission-driven approach is you cut costs on the business side. You accept that there's going to be lower growth. You accept that you're going to burn more cash, or you're going to switch from profitable to unprofitable, but you're still making progress on your long-term goal. And that necessarily means that the business side of those businesses has to be more volatile than the mission-driven side. So the business is basically absorbing the volatility of the mission. And if you're an investor, whether that's a good thing or not really depends on, do you buy into the mission, or were you doing this to make money and you felt like the mission was a really good way for this company to recruit people and maybe to raise money from other investors who aren't as interested in their financial returns but will offer a lot of capital in generous terms. And if that's the case, then the incentives are aligned. Like, you invested in SpaceX because you want there to be a city on Mars. Elon started SpaceX for exactly the same reason. So if there is some time when the choice is either Mars mission or more capex into Starlink, you're very happy that Musk said, we're doing Mars. We have finite resources. We can't spend them on Starlink right now. But if you were investing in order to make money, you kind of hope that the Mars mission is just, it's always 30 years in the future. And there's always some more practical, more cash flow generating thing to do right now.
That's a good overview. I want to point to another piece that you talked about, which is the idea of how shareholder activism turned into a variant on private equity strategies run in public markets. Why don't you share more there?
Yeah, so I recently read a pretty fun book called Dear Mr. Chairman, which is a history of shareholder activism. And like every other financial phenomenon, it is older than it looks. So, and actually, a lot of the stories in the book, they like I'd seen them elsewhere, I'd read about them, but it was nice to actually see them all in one place, because what'll often happen is there will be, like the earliest story chronologically in the book is Benjamin Graham in the 1920s finding this company that was part of the Standard Oil ecosystem of companies. It owned pipelines, but the company also had a lot of corporate bonds and other bonds on the books. And they just weren't disclosing that to investors, but it turned out they were disclosing it to regulators. So Graham went to Washington, D.C., looked at the paperwork, realized that, hey, if you buy this company, you get the pipelines for free because they have so many high quality assets, so many high quality financial assets on the balance sheet. So then he told the company that they should just distribute that to shareholders. They did various really annoying maneuvers where, like, Ben Graham shows up at a shareholder meeting and they tell him that he has to make this a formal motion. No one else is at the meeting, so no one seconds the motion. So the chairman just tells him, "See you next year," and then he eventually does get them to distribute those assets. But like that story, I think it shows up in a couple of books about Ben Graham and Warren Buffett and the history of value investing, but it isn't really tied into some of the other shareholder activist campaigns. And there's this weird spate of them from the 30s to the 50s where this is a time when a lot of people are not paying very close attention to financial markets, and that means there's a pretty big disconnect between the value of underlying businesses and the value of their shares. And also, this is a period where a lot of the really ambitious, growth-focused CEOs, they all lost their jobs because their companies went under. Some of them were growth-focused to the point of being willing to commit or countenance fraud. And so not only did they lose their jobs, but they also went to prison. So this is a time when it's really, really weird to be interested in stocks. And so the people who did activist campaigns were just extremely weird people. And they were, like, some of them were just kind of deluded about the companies that they were involved in. So there was this fight to take control over the New York Central Railroad, where it just, at least the way that the book portrays it, this is the 1950s, it didn't really look like there was a strong case that the railroad was mismanaged. It looked like there was a strong case that railroads were a tough industry to be in, and they were in decline. And the Central did eventually the New York Central merged with Penn Central. The two of them went bankrupt. So it is true that they were in decline and just kept getting worse. But there was a shareholder activist who was able to take a material position in the stock and was raising money on really asymmetric terms, where he was basically letting his investors get most of the upside, and he was going to cover most of the downside. So in that case, it looked like just there were people out there with an interesting gambling sort of instinct, and they opportunistically spotted companies that they thought would be sort of fun to go after. And then as you get to the 1970s, you have another case where there is this disconnect between company value and their stock price, and some of that comes from inflation. And so a lot of those early activist campaigns, there'd be a company where the book value of their assets understated the replacement value of those assets because they'd bought the assets before all this inflation happened, and now it would just be very expensive to replace them. And meanwhile, inflation tends to be terrible for stock prices. So you could have a case where a company could be liquidated for a whole lot more than it's trading at, and you have people who would buy enough shares that they could get a board seat, and then they would sort of so the term for this eventually became greenmail, which is that if you're, let's say, Carl Icahn, you buy 10% of a company at $20 a share. You tell management, hey, your company is worth at least $35 a share. If you don't do something about that, I'm just going to buy the company for $30 a share. There's nothing you can do about it. Like, I will just offer every shareholder $30. They'll all say, enough of them will say yes, that I will be able to get the vote and, get the merger done. And the company would go to him and say, well, what if we just bought your stock for $25 a share? Like, you make a profit. You can leave us alone. And it turned out, Icahn talked about this in later interviews, that he generally didn't actually have the money to take over the company. But in a sort of information scarce environment, you actually have a lot more room to bluff. And Icahn had been a poker player in his youth, so he was aware of the bluffing dynamic. And I think he was also just aware of the dynamic of, if you're an experienced poker player and someone else isn't, and both sides know this, you can bluff pretty hard and often get away with a whole lot. So in that period, you have these very asymmetric deals where people have a lot of, the raiders had a lot of rhetoric about shareholder democracy. And then what they were actually doing was recreating a more oligarchic system where The average shareholder is just kind of along for the ride. You have a few people who can buy enough stock to try to shake things up, but you also have people, managers at the company, who don't own a lot of stock, but they do control the company for now. And they did at the time have the freedom to just pay someone to go away. So you'd have these deals cut between two different competing groups of powerful people, and then everyone else just ends up with a company that is, worth, at least has a little bit less cash on hand, but also has fewer shares outstanding. So it would actually be interesting to go back and look at, did the companies that paid greenmail actually do okay in the end, because the stock was in fact pretty undervalued and they still got a decent deal when they bought it back? And my guess is that for a lot of them, yes, like it was probably better for you as a shareholder for Icon to pretend to take over your company and then get paid to go away than for him not to do that in the first place, because now your company has fewer shares of stock outstanding. And also management is maybe a little more freaked out that someone else is going to try the same maneuver. So maybe they work a little bit harder and try to get the stock price up. But that went away for a couple of reasons. One of which was that you can't run the greenmail playbook that many times before people just realize that's what you're doing, and that you're in the business of making a lot of noise and then getting paid to go away. And that maybe if they don't pay you to go away, you're paying a lot of interest on the money you borrowed to buy the stock. You can't actually afford to take over the whole company. So you're just going to gradually bleed money until you give up. And then the other thing that changed was changing the tax code, where now greenmail does pay a giant surtax. So you could still do it, but it's very tax inefficient. Now you have to just really, really hate the company's management in order to justify doing that. But what also changed was that valuations just got a lot more efficient. Like the market is simply more reflective of the underlying value of companies than it was historically. Everyone loves to name counterexamples. They don't like to show their year-to-date returns. When they do that, I tend to just buy the idea that, yeah, the market is more efficient. There are more eyeballs on more companies, and it's just much cheaper to get data. Like you don't have to go to the SEC reading room to read a 10K. You can just go to sec.gov and pull it right up. And so, yeah, it's hard for valuations to get totally out of whack, but it's still the case that sometimes companies are mismanaged, they're under earning, they're overcapitalized, like they could pay a giant dividend, they could buy back more stock, they can afford to lever up. But in a case like that, if you're a shareholder activist, you actually want to have a more constructive, cooperative approach. Like you want to buy enough stock that the company has to listen to you, and then give them advice that they'd actually want to listen to. And then for your threats to managers who don't play along, for those threats to be credible, you actually do need to tag along for a while with the companies that do just, they let you have a board seat or two, they change some of their strategy, and then, if you're sticking along, the way you get paid is if you were actually right. So what it sort of does is outsource some of the business of capital allocation and corporate strategy to private equity, or not really private equity, but to various hedge funds and at a smaller scale, individual activists. And that actually seems like a healthy development. And it also is part of the broad trend where private companies have gotten a little bit more like public companies, where you can actually, if the company's far along enough, you can probably sell your stock. You can probably buy shares in a private company, depending on the company and whether or not they want you to. But like it's a little bit more of a market. So there's more of a continuum in that direction. But there's also more of a continuum where public equities are a little bit more like private equity, in that instead of KKR buying 100% of the company because they think it's mismanaged and they're going to fix things up and sell off underperforming divisions, now it's more like LE Associates buys 10% of the company, but the company does the same thing and they get a similar kind of return profile.
Hey everybody, Erik here with a word from our sponsors. Fast forward to the end of 2024. Think about your goals. What can you do right now to give yourself the best chance of succeeding? If learning a new language is on your list, you absolutely need to check out Babbel. Babbel offers a range of learning tools, self-study app lessons, live classes, and even podcasts, which have always been my favorite way to learn. Studies from Yale, Michigan State University, and others continue to prove Babbel is better. One study found that using Babbel for 15 hours is equivalent to a full semester at college. Babbel isn't just a game to kill time and make you feel like you're learning a language. It's not overly academic or rigid either. It's all about learning language for the real world. Babbel stands out because it's designed by real people using a modern conversational teaching approach. It's not always easy, nothing worth doing ever is, but it's straightforward and designed to help you start speaking in just 3 weeks. With Babbel, I was able to brush up on my intermediate Spanish to ramp up for travel to Argentina last year, and was able to set clear goals based on how much time each week I wanted to practice. Join millions of Babbel language learners across all age groups. Here's a special limited time offer for our listeners. Right now, get up to 60% off your Babbel subscription, but only at babbel.com/Torenberg. That's babbel.com/Torenberg, spelled BABBEL.com/Torenberg. Rules and restrictions may apply. The tech world turns to the Brave browser for its unbeatable privacy protections. But did you know that Brave also has a private ad platform? Brave Ads offers first-party targeting, and it's been cookieless since day one, so you can relax while third-party tracking cookies disappear from the web. Today, millions of people turn to ad blockers to avoid being tracked and pestered online. But Brave's new ad model aligns incentives for users and advertisers. Users earn rewards for viewing ads, which they can save, spend, or pass along to their favorite creators. And advertisers score points for respecting user privacy, generating ROI without invasive tracking. So whether it's high-impact announcements on the new tab page or keyword-targeted ads in Brave Search offers diverse, private, future-proof ad formats for all your business goals. Join the future of advertising at brave.com/ads. Mention Turpentine to get 25% off your first campaign.
That's a good explanation. Let's also talk about the piece you wrote about this idea of the reason why most extreme one-year returns for stocks often come from companies dying more slowly than expected, not from growth. Why don't you share more here?
Yeah, so this is frustrating to me because I always like the idea of identifying the next great growth company and just buying the stock and sitting on it for 10 or 20 years and getting incredible returns. Like, that sounds awesome. And it is true that over long periods, that is like the two sources of growth over, say, the two sources of high returns over like a 10-year period are either one, you invested in a company that grew substantially over that period, because over the long run, margins have some level of mean reversion, valuation ratios have some level of mean reversion, but revenue does not have to mean revert. You can 10x revenue in a way that you can't continuously 10x margins. So over longer periods, revenue growth does tend to dominate returns. But and then if you look at just a list of the top returns over the last 10 years, the other thing you'll find is, okay, here's a company that in the summer of 2014 almost went bankrupt. They didn't quite go bankrupt. So if you bought then, you happened to buy the low. So that set of companies is going to fluctuate a lot. And then if you look over a shorter period, you will find a lot more cases where a company went through a near-death experience, or just the company wasn't dying as fast as expected. And I think a good example on this is Dillard's, where the stock has actually had an incredible run over time. And one reason for that was that I think everyone kind of recognized for quite a while now that the department store business was a dying business. It's not going to get much bigger. You really don't want to be opening new stores, and it's not like there are new malls that you can add stores to anyway. So there wasn't really much to allocate their additional capital to other than returning it to shareholders, and they happen to choose a buyback. And here's where there is this spring loading effect. If a company trades at a low multiple and they're buying back stock, then their earnings per share actually start compounding, even if earnings on an absolute basis are shrinking. Like if your earnings are going down 5% a year and you're buying back 10% of your stock every year, then on a per share basis, you are back to being a growth stock because your share count is shrinking faster than your earnings. But where this gets magnified is the cheaper the stock gets, the faster that growth rate gets. And so if you are an investor looking at one of these companies and you were kind of indifferent at 10 times earnings and it goes down to 8 times earnings, you actually get to basically double dip. Like, you're buying more earnings for your dollar, but you're also getting more growth per share in those earnings. And this is one reason that these companies can sometimes have just an incredible run where people thought that they'd be out of business in 3 years, and it turns out they'll be out of business in 5 years, but they were able to buy back a lot of stock at 3 times earnings, because that's people thought that 3 times earnings is kind of generous if earnings go to zero in 3 years. So you get these massive wins when that works out right. This also showed up with coal companies a couple years ago, where a lot of them were priced at a low single-digit multiple of cash flow. They didn't really want to be buying more equipment, opening up more mines, mining more coal. So they were just buying back stock, and your share count goes down really fast. And so your earnings per share go up really, really fast if you trade at 3 times free cash flow. But then the problem you run into is, if you're an investor, you're a value investor, you care about these forgotten companies, they're underrated. Every time the stock goes down, you get more bullish because, again, you're double dipping. Like, you get a higher earnings yield and you apply a higher growth rate to that yield. And that makes it really, really easy for people to pour money into dying companies that are in fact just going to die. So it's not really a guide to here's a strategy, like make a list of all the industries that you know will disappear within the next 10 years and figure out which of them actually have 12 years left and you make a fortune. It's more like here is a very, very high variance set of companies. Here's why it's so high variance on the upside. And it's pretty easy to explain why it's high variance on the downside, which is, again, dying businesses. Sometimes they start dying faster than you expected. Sometimes they reach some kind of tipping point where there just isn't a way for their fixed cost to be amortized with whatever incremental profits they can get. And so they suddenly switch from being marginally profitable to like, this company needs to be liquidated and the assets are mostly worthless at that point. So it's pretty high risk, but it's like a fun corner of the market. And it is something to think about when you look at just lists of best performing stocks in any given year, is that it's going to be very heavily weighted towards those companies that are still dying, just not as fast as people believed 12 months ago.
Yeah. Let's segue to what you talked about. We had a couple posts on retailers. So first, you talked about why is their fastest growing business often ads?
Yeah. So in some ways, it's an accounting thing where the grocery business has always had this ad style component most grocers have had this ad style component where there are brands that will pay for particularly attractive shelf placement. So that is basically price discrimination on the part of the grocer, where they know that Pringles is going to pay more to be right at the shopper's eye level, and that there will be competing almost identical products that can be just off to the side, and the more price sensitive customers will hunt for them, and people who are in a hurry will just buy the brand name. So that has always in effect been advertising. A few of the grocers have actually disclosed the numbers on that, and I mean, there was a period where where technically the grocery business, like the actual business of selling food and adjacent products, was a money losing business, but the business of doing that plus selling shelf space was a profitable business. And like any other case where you're selling a very, very close complementary product, or you're doing really, really fine grained price discrimination, like it's not the case that you could just separate these two businesses. Obviously you can't, but it is the case that that's where the profit actually came from. But as people moved their shopping from mostly in store to increasingly pure online, like doing delivery, or doing their shopping in an app and then stopping by the store to pick it up, you just have a lot more opportunities to change what offers you show people based on the data you have about that person. And for groceries in particular, they are a notoriously low margin business. 2% net profit margin is about what you expect in that industry. But the other way to look at that is that they are a business with a very large volume of first party purchase data relative to the value of the overall business. And so if that first party purchase data helps you target ads, those ads are going to perform really, really well. And you'll rapidly pick up information on not just here are the things that this person is likely to buy, therefore we should target them ads for similar products or for competing brands, but also, okay, here are the ads that different kinds of shoppers are likely to respond to. So when retailers turn on an ad business like that, it tends to ramp up really, really fast, because part of what it's doing is capturing all the inefficiency in so if someone like Procter & Gamble is selling diapers to Kroger, there are some customers who Procter & Gamble would pay extra to get. There are some customers where they know that customer is just going to buy the P&G product anyway, so it doesn't really matter. And if all of that shopping is happening through an app rather than in a store, the company that actually controls that app can choose to charge P&G more for the customers that they'd actually be willing to pay more for. So it is this one-time redistribution of some margin from consumer packaged goods companies to the retailers that sell their products. And those one-time shifts, it shows up as a lot of growth. And then at some point it's happened. Like the margin shift has happened. Now the grocery business is more profitable, except that if all the grocers are doing that and they're still competing to get customers and competing on price, you probably have this natural shift towards lower prices. So over the short term, it means faster growth for retailers, especially for the larger retailers, if they are sufficiently tech forward to take advantage of this, which Walmart clearly is. And then over a longer period, it just ends up being redistribution away from consumer packaged goods companies towards the consumers, with retailers as the middlemen taking a cut.
And Should we talk more about this sort of Walmart and the piece you wrote there?
Yeah. So the other fun Walmart thing was Walmart, like Amazon, like many other services, has a membership program, and it's the classic thing where you pay a fixed fee, you get a bunch of discounts on shipping and on various products, but they're adding to the bundle, and the weird thing they added was Burger King. So if you are a Walmart Plus member, you now get discount Whoppers. I'm not sure how many people were specifically asking for that, but it if you think about the economics of the subscription product, the natural thing to do to it is keep adding features and then use that to keep raising the price, because you know that every additional feature is both going to increase overall utilization, which means you, especially if you are also doing ads in your app, which means more merchandise volume and more opportunities to price discriminate and more data that you can use to better target additional ads, both to that user and to somebody else. But also, when you're adding additional features, one of the things that you can do is, for a subscription product, like, you want as many discrete touch points as possible, such that there are many things that a subscriber would miss. This is one reason that it is easier, that you get much better, much lower churn in online streaming video if you have a very broad based kind of generic product versus having a really narrow specialization. So like with something like Netflix, if they have videos for kids and they have documentaries and they have serious dramas and they have comedies, if the Netflix subscriber, if Netflix is subscribed to on a household basis, you need everyone to accept that they're not going to get Netflix content in order to justify churning off of Netflix. So the more family members who are watching Netflix for different reasons, the harder it is for any household to churn out. And similarly with Walmart Plus, if it is the case that now people are buying more Whoppers, like they've shifted their fast food spend slightly towards Burger King away from McDonald's, and now they're kind of used to the fact that they get a really cheap dinner whenever they want. At that point, it's one more reason not to unsubscribe to Walmart Plus. And at the scale of Walmart, you ultimately have to care about churn, because you know that the growth will happen and you'll get pretty far, and eventually you will have, like, everyone who is open to being a Walmart Plus subscriber will have at least done a trial period with it. And at that point, the main determinant of your economics is, can you keep churn low enough that the tiny handful of marginal consumers is able to offset it, such that you have a pretty stable business. And I think this is part of what Amazon has done. They've actually, it seems like they are running into the limits of price discrimination, where they're running into the limits on how big and how expensive can the bundle get before people just say no. So they have sort of adjusted things, where there was like a de facto Prime price hike where you had to pay more to get Prime Video without ads. So that's a price hike for people who just don't like ads, and then it's a slight degradation in the quality of the experience for people who tolerate ads but probably wouldn't go out of their way to look at them. So you do run into those limitations, but it's at pretty massive scale. And in the meantime, reducing churn just means you have more customers who you have more data on them, and you're driving more purchases. So the pace at which you're accumulating data keeps going up, and that's a pretty good situation to be in.
Yeah, that's well articulated. You wrote another piece which was interesting, where you talked about this idea of data center demand, sort of equivalent to running the energy transition in reverse. Why don't you explain that?
Yeah, so I like cases where you can sort of see a trend run exactly in reverse. And the reason it came to mind was that I wrote this thing on the iBuyers recently, because when I first started looking into the iBuying business in 2019, one of the things that struck me was they were playing mostly in the areas that have been the peak of the housing bubble, or at least the peak of new construction in the housing bubble. So like suburban Las Vegas, or various parts of Florida, or Phoenix, Arizona. And then what I realized was the newer buildings, they're all pretty similar. They were all kind of mass produced, and there just hasn't been a lot of time for people to remodel. And the buyers of those buildings often did not have the money to remodel for a while. So you actually have pretty clean data on what new granite countertops are worth, or how much value does an additional half bath add to this building. So that was the place where you'd want to train your model, and then you'd want to go to trickier, messier real estate markets later. And then the last thing you'd want to do is go after really idiosyncratic properties where your model just has nothing to go on because the house is one of a kind. And in this case, it's different drivers, but the same kind of phenomenon, where there have been cases where a new data center gets built, and as a result, a coal power plant that was going to be decommissioned stays in operation for a little while. And the best way to think about this is that the higher the cost of getting permits and the longer the delay for getting permits for either new gas-fired power plants or new solar or wind installations, like the longer the delay and the more expensive it is to just get permission, the more people are just going to ask, is there another power source that is available right now or could be available sooner? And we tend to, in regulatory terms, we tend to treat that like we tend to be very status quo biased in the sense of you don't really need permission. It's much easier to to retain your permission to operate an existing plant or even to bring a plant back online than it is to build something new somewhere else. So the bias by default is that whenever there is a shock to demand for electricity, you're going to expect more of that demand to be fulfilled by legacy power sources that were shut down because they weren't economical. They were also polluting a lot. But if there is marginal demand for power, it's just easier to turn them back on, or especially easier to just keep them running than it is to build something new. And so you can, there are various solutions you could apply to that. One of which is you just say, okay, we're not building any more data centers until we have a more renewables focused grid. But I suspect that permitting reform is going to, will hopefully in the not too distant future make it just much easier to do the thing that presumably the vast majority of these data center companies want to do, which is have cheap power that does not emit any more CO2 than is absolutely necessary. And yeah, that would be good. But I think another piece that's maybe missing from the analysis is if you look at the first order impact, this is bad for the environment. Like we're consuming more energy and we're doing it in a very climate inefficient way. But there is also the question of what is the impact of that energy consumption? And to the extent that it is a substitute for real world activities that are also emissions intensive, the picture gets more ambiguous. I don't think anyone will actually have a definitive answer, or the people who do will not be sharing it. But it is possible that you can imagine a world where there's an incremental new data center built. It is built for, it's used mostly for AI inference. And because of that, people spend more of their time being entertained at home instead of driving to other places to be entertained. I think that's a dark vision for the future, but it is at least a lower emissions version of the future. And it's possible if the elasticities work just right, that actually consuming more coal means lower net emissions. It's probably not the case most of the time, but it is worth thinking about the fact that an increasingly digitized economy does directly consume more power at the data center level, but it also consumes less power to do other activities because a lot of these activities, when they get digitized, they just get much more electricity efficient.
That's a good explanation. A couple other topics before we go that I want to make sure we cover. One is you wrote a piece about the Oracle problem in smart contracts. Can you explain that?
Yeah, so smart contracts are this really fun idea where you can have code that executes based on some information from a third party. So you could imagine things like if you wanted to trade weather derivatives, you could create a smart contract where your counterparty agrees to pay you X amount if the temperature is above some average over some time period, and then you pay them if it's not. Or, and you could imagine this being a tool for risk transfer. So if you own a ski resort, I own a chain of ice cream stores, we're kind of making opposite bets about climate trends. And maybe we just strike some bilateral agreement where we're transferring money back and forth depending on whether this year's weather ends up being better for ice cream or better for skiing. But then you run into a problem with a lot of these, which is, okay, how do you choose a mutually agreeable source for data, and how do you ensure that that source is always going to exist and is going to give you exactly the information you expect it to? So, you could write a web scraper and just, every day you're checking weather.com, but then they redesign the site, your scraper breaks, and now your smart contract is pinging something that doesn't actually give you any information anymore. And there is a sort of quasi solution to this, which is one readily available source of oracles is trade data. So you know that it's a real number. Someone transacted at this value. You also know there's a strong economic incentive to keep providing the data. The exchange is making money, so it's going to keep on operating. And therefore, it's very, you don't really have much of an oracle problem if you create a smart contract that involves some financial asset. So this is why a lot of the excitement and action in crypto in 2021 was we don't just have new tokens to trade, but we have developed completely new ways to simplify and accelerate the gambling on the prices of these tokens. So smart contract that provides margin loans fairly straightforward to think about, a smart contract that provides liquidity. Also straightforward to think about, although people tend not to think about the fact that blindly providing liquidity is sort of implicitly betting against volatility, and those strategies tend to blow up over time. But it was fairly straightforward to solve the Oracle problem in just that domain. And my suspicion is that there will actually be more oracles available over time, because one of the ways that you can reduce the competitive advantage that large scale companies have is that a lot of them, they have a full stack and there are just different layers that add value in different ways. And the more that you require them to let third parties interact with their APIs at any level of the stack, the more the weaker their competitive advantage is. So they can't have some like commoditized product that's really, really high margin because it's buried in some full stack where they own either end of it. And so they force you to use this commoditized thing in the middle that's too expensive. So that gets harder. But it also means there are just more endpoints out there that produce clean, reliable data. The existence of that data is subsidized by whatever business activity led to that API returning some result. And so it is possible that there will actually be way more opportunities to create smart contracts in a world where antitrust enforcement takes the form of forcing companies to open up APIs. And a lot of these tech companies, we know that they're technically capable of it because that is internally how their software is structured. The Google search documentation leak actually had, it's basically a list of here are the API calls, and then there's a lot of speculation on exactly what they did and how they worked. But we know that those APIs exist, just you and I can't use them. And Google actually used to have a search API, and a lot of companies have historically had more generous API access. I guess Reddit is the most recent and notorious example, where it used to be pretty straightforward to build a wrapper app around Reddit. And because the Reddit app was just not especially good for a long time, it was also pretty straightforward to build a better Reddit than Reddit and use Reddit's data. And then one of the things Reddit realized was, hey, one of the biggest, simplest improvements that these third-party developers could make is just removing the ads. But also they recognized that they were losing some control over the user experience. So they massively jacked up prices. It killed off some third-party apps, hurt the economics of other apps. And then some of them had to adjust their model, but they were basically adjusting in the direction of they used to be free writing on something and now they're actually paying for it. But I think does introduce some complexity to the idea of enforcing, weakening a large company's market power by just blanket requiring open access to all internal APIs. You probably don't want to give random third parties access to whatever API, returns a list of all of the emails you sent in Gmail and lets you, then inspect the contents of those emails. Like, okay, we'll keep that one closed for now. But also that you probably don't want to set up where if a company has content and then monetize it with ads, that you allow people to just create a version of that service that has the same content, doesn't have the ads, or has that content and has somebody else's ads. Like, these things do implicitly exist. There are a whole lot of sites that scrape somebody else's content. Maybe they rewrite it with an LLM. Maybe they just randomly change some words. Maybe they just keep exactly the same content and then they put their own ads on it. So that kind of thing does exist. It's tricky to figure out exactly what this setup would look like, but I do suspect that there could be a push for more open APIs, and that means more solved Oracle problems, and that means there are more useful things to do with smart contracts other than levering up your Doge.
Always a good idea. Another piece you covered in your capital gains accompanying newsletter is the carry trade. We had a little bit of scare a few weeks ago. Maybe you could share what you explained in that piece.
Yeah. So this one's really, I think it's fun. So if you think about, different countries issue different currencies, and there are prevailing interest rates in those countries. And it seems intuitive that if a given country has a higher inflation rate, they should have a higher interest rate to compensate people for that. So there has to be some equilibrium, because if there weren't, everyone would just, in inflationary countries, they just move all their savings into the currencies of deflationary countries, and then the currency would have to drop until that's no longer a good bet. So you would think that if interest rates, let's say the interest rate differential between the Mexican peso and the US dollar is 8%, that probably means that your pesos depreciate by about 8% relative to the US dollar each year. And it turned out that if you ran the numbers historically, I think up through the financial crisis, if you just blindly borrowed the lowest yielding currencies and invested and just put your money in the highest yielding currencies and got whatever the usual interest rate is, you would actually make money on average. So your currency would often depreciate, but not always. But it was much more than offset by the positive carry, i.e., the positive interest rate differential. And people got pretty used to that and realized that was pretty easy money. And then it turned out that because there were a lot of investors who were running currency carry trade strategies and running other strategies, and they were levering up because they have all these different sources of returns, it turned out that when some of those returns, like maybe the returns from levering up a portfolio of highly rated triple A rated CDOs backed by subprime mortgages, if that part starts blowing up, you have to liquidate other assets. And the CDOs were hard to sell, so you had to sell something else. And the currency market is one of the most liquid out there. So that stuff got liquidated pretty hard. So suddenly the previously uncorrelated strategy ended up being perfectly correlated with what was going on in the equities market and what was going on in the worst parts of the credit market at the worst possible time for it to be correlated, when everything's going down. So, and then since then, the currency, the carry trade picture has been fuzzier, but it is true that there were a number of investors who were borrowing Japanese yen and investing in Japanese equities or investing in assets denominated in other countries with higher yields. And so if you're doing that, you're basically saying, I expect the yen to be maybe stable, maybe actually appreciate slightly against whatever these other currencies are, but not appreciate as fast as that rate differential. But if you're doing that at scale, if the marginal person determining the yen to dollar exchange rate is someone who is borrowing yen to buy dollars and not necessarily thinking about how that market has evolved, then you have a lot of fast money in the trade, all on one side of the trade. And then if there is some blip, or the Bank of Japan makes some noises about raising rates, then suddenly everyone gets out at the same time, and it turns out your carry trade was not an especially good one. So these were a pretty big deal in the financial crisis, because you had a lot of people who were essentially lending money to developing markets and then borrowing dollars, euros, Swiss francs to do so. You also had weird stuff like, for a while it was trendy in Europe to take out a mortgage denominated in the Swiss franc because your interest rate would be really low. And then if your country's currency crashed, but the Swiss franc actually went up because everyone is rushing to the safe haven currency because there's a financial crisis, well, suddenly your mortgage is much, much more expensive, and you probably also lost your job. So carry trades are pretty dangerous, but I would say, if you think of the space of potentially dangerous carry trades, probably doing a carry trade between two large countries that have real economies and where there are real world use cases for their currencies, that is probably systemically pretty safe. Like, the central banks can intervene on either side if things get too crazy. They have a fair amount of visibility into this, and the institutional confidence is high enough that they can probably withstand this. But yeah, that's the carry trade situation. It is like, it's one of those strategies where it feels insane that it would ever work. Like, all you do is make a list of currencies and order them by yield, and you borrow the low yield ones and buy the high yield ones. That actually made money for a while. And it turned out that, like a lot of other ways to passively make money, what was ultimately going on was you're selling insurance. You're selling insurance against a financial crisis that hits the developed world, but also hits the developing world a whole lot harder and a whole lot faster. And that's the point at which you lose a bunch of your money in that carry trade.
Well, with 1 minute remaining, Ryan Breslow, is there a world in which this turns out well for him? It turns out this was a very badly structured deal. Is there a world in which he gets away with it?
I mean, I can imagine a lot of worlds where it turns out good for him. My view on that deal was, you basically want to read the terms backwards, because the high level headline thing of they're getting an investment at a $14 billion valuation, like, there were two investors, one of whom, it was going to be a little brokerage company, which I got the impression was actually not really big enough to do that deal itself. That company said, no, we're not doing it, but one of our employees apparently knows someone in the Middle East who does want to do it. And then, so we have like mystery investor number 3, because mystery investors 1 and 2 disappeared without notice. And then you also have the company that claims it's investing only in the form of marketing credits. So it's a company that is in touch with influencers and can use them to influence people, and it can value that. That company raised, I think, under 25 million a couple months ago, and says they're investing $250 million worth of influence. So either it's the best marketing company of all time, and they can get 10x the marketing dollars, that they can turn X amount of real dollars into 10x that in marketing dollars, or they're investing a currency whose value they set themselves, and it's overvalued. But the part of the deal where you have to either put more money in or you get your shares zeroed, that actually seems more plausibly like something that could end up happening. Maybe not in precisely that form. Apparently it does require a vote, but when a company is not growing and clearly most investors have mentally written it down to zero, there is sometimes room for the last few true believers and or the founder, or in this case, founder who was ejected as CEO but was still kind of hanging around. Like, there is room for them to strong arm the last couple investors. And there is, very cynically, there is alpha to be had if someone wrote down an asset to 2 cents on the dollar, and you can tell them, you basically think of it as zero. So how about I give you 0.1 cents on the dollar? And, 2 cents on the dollar is a whole lot less than Breslow was worth 3 years ago, but it's, it's still additional money. So I don't know, like, a lot of times when companies are dying, or going through a rough patch, they do need to be recapitalized. Like, the investor base is not the set of people who actually want to own that company. There may be a set of people who do actually want equity in that company, and making that happen, it requires some sharp elbows, but I don't think it requires near the level of weirdness and misdirection that this offer had. So I think it gives a bad name to what is already just an unpleasant category of financial transactions.
Yes. Well, on that note, let's wrap this episode. We didn't get into any politics, coverage this time, which is a
Thank
nice
you.
change.
I'm safe.
Yes, exactly. Well, Byrne, always a pleasure. Until next time.
Yes, indeed. All right. Great chatting. Talk soon.
Thanks for listening to The Riff. Please go follow and subscribe, give us 5 stars, and check out Byrne's excellent newsletter, The Diff, if you haven't already.